Welcome back to the channel GS Boring Currency. What if I told you a billionaire trader made a bet so big it shook the entire silver market? This is the insane story of Beyond Seeming, a financial titan who went all in, shorting silver with everything he had. He gambled on prices falling, and boy, did they fall. In a jaw-dropping move, he raked in an unbelievable $288 million. How did he pull it off? Stick around to find out. The position. When scale itself becomes risk, the silver market is often described as small, opaque, and easily overlooked. Yet precisely because of these characteristics, it becomes disproportionately sensitive to scale. When a single trader's position reaches hundreds of millions of dollars, the trade itself stops being a private wager and begins functioning as a public signal. The $288 million silver. Short at the center of this analysis must be understood in those terms, not as a headline, but as a structural event. A silver short position represents a bet that prices will decline. In practical terms, the trader borrows exposure to silver, typically through futures contracts or derivatives, and sells it into the market with the intention of repurchasing it later at a lower price. The difference between the sale price and the repurchase price becomes profit. This mechanism is neither novel nor controversial. It is foundational to modern commodities markets. What matters here is not the direction of the trade, but its magnitude. At smaller scales, short positions serve a balancing function. They provide liquidity, enable price discovery, and allow producers or consumers to hedge risk. At extreme scales, however, the character of the position changes. A $288 million short in silver is not merely a directional view. It is an exposure large enough to interact with market structure itself. Liquidity, margin requirements, and counterparty capacity all become relevant constraints. The growth of this position coincided with declining silver prices. On the surface, this appears rational. As prices fall, a short position increases in notional size without requiring additional capital. This creates the impression of momentum and validation. Yet this dynamic contains an embedded risk. The position expands precisely when the market becomes thinner and more one-sided. Scale increases while flexibility decreases. To understand why this matters, one must distinguish between price movement and market depth. Silver prices can decline without significant physical selling. Futures markets allow vast quantities of paper silver to trade hands without any immediate requirement for delivery. This abstraction enables large positions to form quickly, but it also disconnects price signals from underlying supply constraints. When a short position grows large relative to available liquidity, the exit path becomes narrow. The identity of the trader further amplifies the signal. Billionaire traders operate under different constraints than retail participants. They have access to leverage, preferential financing terms, and sophisticated risk models. When such an actor commits capital at this scale, observers infer conviction. Yet conviction does not eliminate structural limits. In fact, large traders face a paradox. Their very size reduces their ability to adjust positions without influencing prices. This is where the trade transitions from opportunity to vulnerability. A short position benefits from declining prices, but it is theoretically exposed to unlimited losses if prices rise. Under normal conditions, this risk is managed through stop losses, diversification, and hedging. At extreme scale, however, these tools become blunt. Closing a large short requires buying into the market. If liquidity is insufficient, that buying pressure itself drives prices higher, compounding losses. The expansion of the silver short to $288 million suggests confidence in a specific macro environment. Implicitly, it assumes stable monetary policy, contained inflation expectations, and no sudden demand shock for physical silver. It also assumes that market plumbing, clearinghouses, margin systems, and counterparties will function smoothly under stress. These assumptions are rarely stated, but they are embedded in the trade. Importantly, this position is not isolated. Large trades cluster around narratives. In this case, the narrative centers on higher interest rates, a strong dollar, and reduced demand for monetary metals. As more participants align with this view, positioning becomes crowded. Crowded trades are profitable until they are not. Their failure mode is abrupt, not gradual. For decision makers, the lesson is not to emulate the trade, but to interpret it. Extreme positioning reveals where confidence is concentrated. It shows which outcomes are being discounted and which are being ignored. When a single position reaches a size that rivals market liquidity, it stops being a forecast and becomes a stress test. The silver short at this scale is not simply a bet against a metal. It is a wager on stability, on the absence of disruption. History suggests that such wagers deserve scrutiny, not admiration. The question is no longer whether the trade is currently profitable. The question is whether the system can absorb it if conditions change. This is where the analysis must turn next, away from the trader and toward the market mechanisms that allow such positions to exist and the hidden fragilities they conceal. Have you ever wondered why the price of silver can drop even when it feels like the world is getting riskier? It seems counterintuitive, right? Well, the answer lies in how modern silver markets actually work. It's less about physical bars and coins and more about paper. The global silver price isn't set by people buying and selling actual metal. Instead, it's determined in financial markets through things like futures contracts and options. These are essentially bets on the future price of silver. This system allows traders to control huge amounts of silver with a relatively small amount of their own money, a concept known as leverage. So when you see the price falling, it might not mean there's less demand for physical silver. It could simply be that powerful players in the paper market are pushing the price down. When prices start to fall, it can actually become cheaper for them to increase their bets against silver, creating a downward spiral. Computer algorithms often jump on this trend, selling automatically and pushing the price even lower, regardless of what's happening in the real world. This creates a strange paradox. A falling price might make it seem like silver is a bad investment, but it could actually be a sign that a huge amount of pressure is building up in the system. The market becomes more and more one-sided. But what happens when a sudden shock hits? Maybe a supply disruption or a big surge in physical demand? That's when the paper market can't keep up. The carefully constructed system can break, and the price doesn't just gradually recover, it can explode upwards. So a falling silver price doesn't always mean lower risk. Sometimes it's the quiet before a potential storm. All right, so we've established that the silver market is far from simple. Let's pull back the curtain on who's really pulling the levers in the paper market. We're talking about the big players, the bullion banks and large hedge funds. These institutions aren't necessarily buying silver because they want to take delivery. Instead, they often profit by taking massive short positions. Essentially, they're betting that the price of silver will go down. They do this using futures contracts and other derivatives, creating immense downward pressure on the spot price you see on your screen. It's a high-stakes game where they can profit from price declines, often at the expense of smaller investors who are long silver. So how do we keep an eye on what these giants are doing? That's where the Commitment of Traders report, or COT report, comes in. This weekly report from the U.S. Commodity Futures Trading Commission is a treasure trove of data. It breaks down the positions held by different types of traders: the commercials, which are the big banks, and the non-commercials, like hedge funds and individual speculators. By analyzing the COT report, we can see when the big banks are building up unusually large short positions. Historically, when their short positions become extremely large, it often signals that a price drop is coming. Conversely, when they start covering those shorts, it can signal a bottom is near. It's not a crystal ball, but it's one of the best tools we have to gauge market sentiment from the inside. This isn't a new phenomenon. The silver market has a history of dramatic tugs of war. Let's go back to 1980 and talk about the Hunt brothers. They attempted to corner the silver market, buying up enormous amounts of physical silver and futures contracts. Their buying spree drove the price from around $6 an ounce to nearly $50. It was an epic squeeze. However, the exchanges changed the rules, essentially forcing them to liquidate, and the price crashed spectacularly. This event showed just how powerful a concentrated buying effort could be, but also how the system could react to protect itself. Fast forward to 2011. Silver went on another incredible run, soaring to just under $50 an ounce again. The public was piling in, demand was red hot, and it looked like silver was heading for new all-time highs. Then, over a single week, the price was smashed down by about 30%. This was driven by a series of margin hikes on the futures exchange, making it more expensive to hold a long position. Many believe this was a coordinated effort by the big players to break the back of the rally and profit from the subsequent price collapse. This brings us to the more recent jarring silver squeeze movement that exploded on social media. Inspired by the GameStop saga, a community of retail investors decided to target the silver market. Their goal was to buy up physical silver and silver-backed ETFs to expose the disconnect between the paper price and the real-world supply. And what happened? It caused chaos. Premiums on physical silver coins and bars skyrocketed. You might see a spot price of $25, but have to pay $35 or more to actually get your hands on a physical ounce. Dealers were completely sold out. This event powerfully demonstrated that while the paper market can dictate the price, it doesn't always reflect the true availability of physical metal. That massive premium is the market screaming that physical silver is much scarcer than the paper price suggests. So, what could finally break this dynamic and trigger that violent correction we talked about? A few catalysts could do it. First, a loss of confidence in the futures exchanges. What if a major player, like a big bank, defaults on its delivery obligations? That could set off a chain reaction. Second, a massive surge in physical demand that the system simply can't meet, leading to a full-blown delivery failure on the COMEX exchange. Third, a major geopolitical event or currency crisis that sends investors flocking to silver as a safe haven, overwhelming the paper shorts. Any of these scenarios could cause the paper price to rapidly converge with the much higher physical price, resulting in an explosive move upwards. The stage is set, and many believe it's a matter of when, not if. Have you ever wondered why even the smartest traders, the ones managing billions, sometimes make catastrophic mistakes? It's not always about greed or being reckless. Often it's a deep-seated psychological trap called the actor incentive. This is the tendency to press a winning trade, to double down on what's working, even when the risks are quietly piling up. Today, we're going to dive into two of the most infamous financial meltdowns to see how this played out in the real world. First, let's talk about long-term capital management, or LTCM. In the mid-1990s, this hedge fund was the stuff of legends. It was run by Wall Street superstars and even had 2 Nobel laureates on its board. Their strategy? They used complex mathematical models to find tiny price differences between related securities, like 2 different types of government bonds. They'd bet that these prices would eventually converge. The trades were individually low risk, so to make real money, they had to use massive amounts of leverage. For every dollar of their own capital, they borrowed over $25. For a while, it worked brilliantly. They were hailed as geniuses, posting annual returns over 40%. They were the ultimate sophisticated actors. Their models were winning, so they kept applying them, taking on more and more leverage. They were pressing their winning trade, but their models had a fatal flaw. They assumed that markets would always be rational and liquid, and that historical patterns would hold. Then, in 1998, Russia defaulted on its debt. Panic swept through the global markets. Investors fled to the safest assets possible, and the small price differences LTCM was betting on didn't converge. Instead, they blew out to historic widths. This was a black swan event their models never predicted. LTCM's positions started hemorrhaging money. Because they were so heavily leveraged, their losses were magnified exponentially. They were too big to fail and too big to save themselves. The market liquidity they relied on vanished. Ultimately, the U.S. Federal Reserve had to step in and orchestrate a massive $3.6 billion bailout by a consortium of major banks to prevent a complete collapse of the global financial system. LTCM's belief in their own sophisticated system, their actor incentive to keep pressing their strategy, led them straight off a cliff. Now, let's fast forward to 2012 and meet the London whale. This was Bruno Ixel, a trader at JP Chase's chief investment office in London. His job wasn't to make speculative bets, but to hedge the bank's overall risk. He started building a massive position in credit default swaps, essentially a form of insurance on corporate debt. Initially, his strategy was successful and generated huge profits for the bank. He was seen as a star trader. He had a winning hand, and the incentive was to play it bigger. His position grew so enormous that it started to distort the market itself. Other traders noticed this whale and began betting against him, knowing that such a concentrated position would be impossible to unwind without causing massive price swings. Here we see the same patterns as with LTCM. First, an overconcentration in a single strategy. Second, a flawed risk model. The bank's own value at risk model, which was supposed to measure potential losses, was underestimating the true danger. It was like driving a car with a faulty speedometer. And third, liquidity risk. When they finally tried to reduce the position, they couldn't. The market knew what they were doing, and there were no buyers on the other side. The result? What started as a hedge turned into a massive speculative loss. JP Chase ended up losing over $6 billion. The London whale's story is a powerful reminder that even when you're supposed to be managing risk, the incentive to press a winning strategy can turn you into the biggest risk of all. So what's the takeaway from these stories? LTCM and the London whale show us that no matter how sophisticated your models or how smart you are, the actor incentive is a powerful force. The belief that your winning streak will continue can lead to overconcentration, a failure to see the flaws in your own models, and a dangerous disregard for liquidity. It proves that in the world of finance, past performance is truly no guarantee of future results, and sometimes the biggest risk is believing you're too smart to fail. There's a massive one-sided bet being placed in the silver market right now. And it's not just about silver. This isn't a trade for profit, it's a public warning signal. Think of it as a smoke detector for the entire global financial system. Today, we're going to break down exactly what this signal is telling us, why it matters to you, and what lessons we can learn before the alarm bells start ringing for real. So, what is this trade? In simple terms, a huge number of professional traders are betting that the price of silver will go down or stay flat. This is known as being short silver. But to understand why this is so significant, we need to deconstruct the assumptions that make this bet seem like a sure thing to so many people. First, the trade assumes inflation is under control. The narrative we've been hearing is that central banks have successfully tamed rising prices, and we're heading back to a stable, predictable economic environment. If inflation is truly beaten, then there's less reason for investors to buy hard assets like silver as a store of value. Second, it's a massive vote of confidence in central bank credibility. The traders making this bet believe that institutions like the Federal Reserve have the tools, the foresight, and the will to keep the financial system stable. They are betting that the era of whatever it takes is still in full force. Third, this trade relies on the assumption of stable and liquid funding markets. Shorting any asset requires borrowing, and that process depends on a smooth functioning financial plumbing system. The bet is that there will always be available cash to fund these positions, no matter what happens. And finally, it treats silver purely as an industrial commodity. While silver is used in everything from solar panels to electronics, this view conveniently ignores its centuries-old role as a monetary metal, a safe haven during times of crisis. These traders are betting that its industrial side will outweigh its monetary side. So you have this giant bet all piled on one side of the boat, based on a set of very optimistic assumptions. This brings us to a concept financial professionals dread: crowded positioning. When everyone makes the same bet, it creates a dangerously fragile situation. The exit door is only so wide, and if everyone rushes for it at the same time, chaos ensues. We've seen this movie before. Think back to the 2008 financial crisis. A key trigger was the crowded bet on mortgage-backed securities, which everyone assumed were perfectly safe. Or consider the collapse of long-term capital management in 1998. A hedge fund run by Nobel laureates made highly leveraged bets that seemed infallible until they weren't. When a small, unexpected event occurred, the models broke, and the crowded positions had to be unwound at fire sale prices, nearly taking down the entire system. In both cases, extreme confidence led to extreme fragility. The silver short trade has the exact same characteristics. So what does this mean for business leaders, investors, or anyone just trying to navigate the economy? It's not enough to simply read the signal, you need to act on it. For business leaders, this is a call to action. It's time to stress test your financial models. What happens to your business if interest rates don't go down as expected? What if your cost of borrowing suddenly spikes? Don't just rely on the consensus forecast. Model the unexpected. Diversify your risks. Are all your suppliers in one region? Is all your financing from one type of lender? Now is the time to build resilience, not chase the last few percentage points of efficiency. Let's walk through what could happen if this crowded silver trade starts to unwind. It won't be a slow, orderly process. It would be a cascade. Imagine a small, unexpected event, maybe a geopolitical flare-up or a surprise inflation report. Silver's price, instead of going down, ticks up sharply. The first domino to fall is the margin call. The traders who are short silver start losing money, and their brokers demand more collateral to cover the losing positions. To get that cash, they have to sell other assets, maybe stocks, maybe bonds, whatever they can liquidate quickly. This selling pressure starts to bleed into other markets. Next, we see counterparty stress. The firms that lent money or silver to the short sellers start worrying if they'll get paid back. Trust begins to evaporate. This leads to the freezing of funding markets. Suddenly, the very liquidity that the entire system depends on dries up. No one wants to lend because no one knows who is secretly insolvent. This is how contagion spreads. A problem that started in a niche market like silver suddenly becomes a systemic crisis, affecting everything from the stock market to corporate bonds to the ability of everyday businesses to get a loan. This is the unwind cascade, and it happens with terrifying speed. History is filled with warnings that financial systems don't bend, they break. And they almost always break at the point of maximum confidence. The economist Hyman Minsky described this cycle perfectly. He argued that periods of stability and prosperity actually sow the seeds of the next crisis. People become complacent, they take on more risk, and they leverage up, believing the good times will last forever. This leads to what's known as a Minsky moment, the point where everyone realizes the assumptions were wrong and rushes for the exits all at once. The current confidence in central banks and the belief that risk has been vanquished feels eerily similar to the periods just before major historical meltdowns. So, the massive short position in silver isn't just a bet on a metal. It's a proxy for a much larger question. How resilient is our financial system, really? Is it a robust structure capable of withstanding shocks? Or is it a fragile house of cards built on a foundation of cheap debt and unwavering faith in a handful of institutions? The traders are betting on the house of cards standing. History suggests that's a dangerous bet to make. The signal is flashing red, not because a crisis is guaranteed, but because the conditions for one are now firmly in place. The time to prepare is now, not when the cascade has already begun. Thank you so much for joining me for this deep dive. If you found this analysis valuable and want to stay ahead of the critical trends shaping our economy, make sure to subscribe to the channel. We'll see you in the next video.